Are software companies gonna die? In the last few months, we have seen tech stocks fall a lot, especially software companies. Adobe stock has fallen almost 32% over the last 6 months. Constellation software has fallen 46%, and there's a lot more. I think the fear going around is that AI is gonna kill these companies because you can do what you do with these companies just by using LLMs, and also coding new software will be so much easier that anyone can, with a simple prompt, create their own version of, let's say, for example, of Adobe Photoshop. Also, there's a lot of competition out there, especially for Adobe. Affinity software just became free. There's also DaVinci Resolve, and for normal people, buying for Adobe software, for example, is not worth it. Today we're going to talk about this in a bit more detail, and we're going to watch a video from The Invisible Game. I haven't watched this yet. The overdue collapse of software companies. Let's see it.
No industry has reshaped the world over the last 20 years more than software. It turned floppy disks into apps that live on the cloud, days of manual labour into minutes of automation, and created hundreds of billion-dollar companies in the process. But that gold rush is coming to an end. In less than a year, the popular language learning app Duolingo fell more than 60%, work management platform Monday.com 53%, and Figma, a web design company that had one of the largest IPOs in 2025, has lost more than 75% of.
That's rough. I didn't even know of these companies and their losses. Duolingo I knew about, but that's a lot.
Its value. None of these businesses were struggling startups. They were some of the largest software companies of the past decade, but now they're all collapsing for the exact same reason. And while you might think this is just another stock market wobble caused by things out of their control, that couldn't be further from the truth, because after decades of sitting at the top of the tech industry, software companies are now facing a fundamental shift that's threatening the very business model the entire industry was built on. A change that's making millions of users question if they
strengthen
already an ad. What is she?
Products anymore.
Tech is the worst performing sector so far this year. Is this just a pause?
The software sector as a whole has lost about 30% of its value.
To understand why this trillion-dollar industry is collapsing so quickly, it's worth going back to what made the industry so valuable in the first place, and how this booming success sowed the very seeds for today's unraveling. In the early 1990s, businesses looked and operated very differently from how they do today. Recording financial transactions meant writing figures down in a physical ledger. Making presentations meant spending hours arranging texts and images on a poster board, and creating documents meant using a typewriter. One mistake and you'd have to start over. Long story short, business operations were extremely slow and error prone, but then programs like the Microsoft Office family, PowerPoint, Excel, Word, the Three Amigos came into them, doing the same tasks but faster, cheaper and more efficiently. And while this was enough to drive mass adoption of software products, it still came with its own set of challenges. Back then, even using a program like Microsoft Word meant buying a physical disk, installing it on every computer manually, and repeating the entire process when there was an update. This made software extremely difficult and expensive to use, restricting companies to just a handful of programs. But there wasn't really an alternative. That was until 1989, when British researcher Tim Berners-Lee built a system that allowed computers around the world to share information almost instantly across the internet, what we now call the World Wide Web. At first, companies mostly used this to move existing business models online, like Craigslist for jobs or Amazon for markets. But one startup saw something entirely different: a new distribution channel. In 2000, San Francisco-based startup Salesforce launched its customer relationship management software, but unlike other companies at the time, instead of selling it on a disk, they ran it on their own servers and delivered it straight to users through a website. In less than 2 years, Salesforce had scaled to more than 3,000 enterprise customers and $22 million in revenue, becoming the world's fastest growing CRM platform at the time. You see, without the need to manufacture CDs, print manuals, or ship physical copies, Salesforce could scale faster and reach customers traditional software companies couldn't. It was a trade-off. Initial higher infrastructure costs on things like servers and maintenance, but once you were up and running, those expenses were nearly insignificant compared to the savings on labor, materials, and logistics which you used to need in order to sell a physical product. This was something of a revelation, as now every new paying customer was essentially pure profit. Soon, other companies started building businesses around the same model. Workday launched cloud-based HR and finance software. ServiceNow launched cloud workflow automations tools, and Atlassian launched Jira for project tracking, each selling software as a service, not as a product. But what really turned software into a gold rush wasn't just the product. It was the timing. You see, after the 2008 financial crisis, in an effort to stimulate their economies, central banks in Western nations around the world dropped interest rates to near zero. And with rates so low, investors began looking for anywhere they could get better returns than 1% banks were offering on their savings. In less than a decade, annual venture capital investment in the United States ballooned from nearly 640%, from $45 billion to over $330 billion. And coupled with the fact that borrowing was so cheap, software companies now had an abundance of cash to scale. This prompted a simple but somewhat flawed strategy: raise millions in venture funding, acquire users as fast as possible, and worry about profitability later. Uber burned through $10 billion to become the world's largest ride-hailing service. WeWork.
I think this idea of like software companies just burning money, it's been going on for a long time, and I think recently in the last few years we have seen it like get to a point where it's not really working anymore with the interest rate hikes. You know, these companies, they can't do it anymore because money is not free anymore. So, you know, you just can't burn money to a startup like over and over again. There's a lot of companies that struggle with this. For example, a good example for me, a local example, is that Foodora ceased their operations in Finland. They were for a long time trying to compete with Wolt and giving all these crazy deals. You know, I remember a few years ago I used to like always order from there. I just got a new prepaid and made a new account, and you could order for €5 like 2 pizzas delivered. So they were taking a loss on that. But there's a lot of examples like this with companies kind of throwing money at it and just trying to grow. And we've seen lately that they have not, you know, panned out like they probably hoped.
18 billion. And for 15 years, Spotify burned through billions to establish itself as the world's largest audio streaming platform. This kind of software gold rush all culminated in 2021, with central banks again drastically cutting interest rates to boost economies after the COVID-19 slowdown. And just like that, the 2010s borrowing became extremely cheap. That year alone, venture capital firms invested a record $120 billion into software companies, flooding them once again with cash. By 2022, half of the world's top most valuable companies were software ones. And when it came to profitability, they dominated the rankings as well. But interestingly, for most software giants, even with their millions of users, the majority of their revenue came from a single group, businesses. In 2025, despite powering over 1 billion personal computers globally, roughly 70% of Microsoft's revenue came from a smaller set of enterprise customers, a pattern that repeated itself across the entire industry. And it's not too hard to see why. Without CRMs, businesses can't keep track of which clients are which. Without cloud storage, teams can't collaborate on the same document. And without scheduling software, coordinating a single meeting can take multiple days of back and forth calls. Basically, in the 21st century, it's become nearly impossible for most businesses to operate without software. And while individuals can often get by using whatever is offered in free tiers, businesses can't. Just when productivity determines profit, not paying for the better version of tools that maximize efficiency can be the difference between staying ahead or falling behind. For decades, businesses have faced a growing problem with software. There's simply too much. A typical company uses Slack for communication, QuickBooks for accounting, Photoshop for design, Salesforce for customer management, Excel for data analysis, and that's barely scratching the surface. In 2023, American companies were using an average of 371 software products, each with its own interface, learning curve, and monthly subscription, costing them up to $7,900 per employee per year, more than what they were spending on employee healthcare. For most businesses, this hasn't really been a choice. After all, without these tools, productivity falls, and that dependency becomes incredibly profitable for software companies. You see, when a business has years of financial data stored in QuickBooks, or thousands of customer emails which are backed up on Outlook, it wouldn't just switch to another platform for a small operational saving, because pretty much every other cost associated with this move would just be too high. That's why in 2025, enterprise SaaS companies had a customer churn rate of just 4%, 3 to 10 times lower than other industries. In other words, Once a business signs up, they stay. And that's created something investors love: predictable recurring revenue. One of the main reasons software companies have such high valuations. But building an entire business model around exploiting a single dependency is extremely risky, because if a new technology suddenly comes along that delivers the same results faster and cheaper, then all of a sudden you don't have a business anymore.
Software stocks have become ground zero for investors' anxiety over the possible disruption from AI.
This is a growing fear among investors as all these AI models become so prolific. They seem to offer all kinds of capabilities. The idea that you're going to continue using these sort of more niche software platforms, it seems a little bit iffier right now.
By 2023, Google,
Yeah, that's it.
OpenAI and Anthropic had all released their own AI assistants. At first, they seemed like fun gimmicks, chatbots that could write essays and answer trivia. Impressive, but nothing too revolutionary. Over the past few years, however, these AI models have gotten way better, not just at answering questions, but performing actual tasks. In February 2026, Anthropic launched a legal tool as part of its Claude Cowork feature, and according to the team at Anthropic, Claude will now be able to help law firms automate legal work, like contract reviews and compliance workflows. And while it's yet proven to be useful, just the news of this release was enough to send the stocks of legal software makers down nearly 15% in a single day. For decades, software companies have built empires by unbundling business functions into specialized tools, each one carving out a specific problem, building a solution around it, and charging a monthly subscription for that luxury. But suddenly, the very foundation of that model is being called into question, because businesses are now starting to ask, if AI agents can write code, create financial forecasts, and design social media posts, why should we keep paying for dozens of separate software products that do the same thing? In 2025, Figma had one of the most anticipated IPOs of the year. After all, this was the tool that had been used to design nearly every website or app created in the last decade. On its first day of trading, retail investors, eager for a piece of the company, shot its valuation up by 250%, and by the end of the week, it had reached a valuation of around $60 billion. However, just 7 months later, it was down to $10 billion, 80% of its value gone, leaving the same question on everyone's mind: what had just happened? Well, thanks to AI tools like V0 and many others, what used to require teams of designers, dozens of Figma subscriptions, and weeks of work could now be done in minutes by simply typing in natural language, create a landing page for a fitness app. The core value proposition of a 60 billion company reduced
Is this ad? This is ad. This might seem like ad.
to a 10-word prompt. At its core, this is the real threat agentic artificial intelligence poses to software companies. Now, knowledge of this threat has been around for a while, but it seems only now Wall Street is starting to notice. Over the past few
Let's pause this. The big question for us: what will happen? The main thing that I'm trying to predict and I'm thinking about is the revenues of these companies. I have already invested in Adobe stock after the fall. I think at a P ratio of 15 with good growth, a no-brainer. But the truth is that I wouldn't pay for Adobe products, and that is a good indicator, in my opinion, for a good company if I were to pay for the products, because I'm really cheap. But on the other hand, do I see companies leaving Adobe subscriptions? I right now work as a graphic designer in the Finnish National Defense University, and I use Adobe software every day in my job. And to be honest, I don't see them like leaving Adobe anytime soon. The thing is that it just has such a good moat, because let's think about it. There's like tens of years of old projects on a cloud drive, on a hard drive, and all of the projects are in Adobe formats. So if I want to open an old project, I need to have the Adobe software to be able to open them. There's some workarounds there, of course, with, for example, with Affinity tools, you can open up Adobe projects, for example, but it's not perfect. Then there is all the people. There's all the people that know how to use Adobe software in the kind of, it's not a company, but you know, in the organization. So to train all the people on some new software in the organization, it would be a big thing. Then there's Adobe Acrobat that probably everyone uses. And in the organization, there's probably hundreds of people that use the software. They're used to the software. There's a lot of people making books, presentations, whatever. And if they were to change from Adobe Acrobat, for example, to something free like PDF Gear right now, it would make it so much slower. Everyone would be annoyed, productivity would go down, it just would be bad. So I think right now we're in a position where I feel comfortable with AI, with these software companies, that they will be useful. Once again, there's a lot of software that will not. For example, I think the legal software is one area where I think there will be a big disruption, because legal services and lawyer services are basically mainly going through the law and going through old court cases. And that is something that AI is really good at. AI is really, really good at reading and interpreting these, old decisions. So that's something that I would probably stay away from. Now that we think about Adobe, it's kind of there and there. I see there's a lot of competition, there's a lot of free softwares, and then there's the argument that LLMs are gonna replace this software. That is not gonna happen. That is just not gonna happen, because the truth is that we need software that is as fast as possible to do what we want to do. And it's really, really, really hard to describe in words what you're trying to do visually. And it's much easier when you see it visually. I think there might be some sort of tools where you talk, and for some, of course, for some purposes, LLMs will replace Photoshop with like photo editing, for example. I think it can be really good. And also, but like if you think about, like, for example, making book covers or making magazines, there's a long way to go. I think AI will be interpreted into this, but I think still companies like Adobe are in a good position to use AI in their softwares themselves, and I don't think it just will be replaced by LLMs like anytime soon, because it's just a visual interface. We need something faster where your brain and your ideas go visually onto the screen, and right now, typing and using a mouse is the best way to do it. And LLMs, they're not that much better. If they were able to be connected to your brain through Neuralink or something, of course it would be much better. But then again, then it wouldn't be about the AI, it would just be about the connection there. So as long as companies like Adobe are implementing AI into their software, and they've done it well, in my opinion, so far, I would not be worried about holding the stock myself. I think the stock price will bounce back when people realize that the customers are not going anywhere anytime soon, and it's a long way to go. I think what we're seeing maybe right now is something that is going to be similar to, for example, the dot-com bubble, that we're looking too far ahead. Because in the 2000s, I wasn't even born then, the stocks went up and up and up and up, and there was this hype and ideas of the internet, that the internet will be so great, it will change everything. And to be honest, it definitely did, but it got way too far ahead of itself. Companies that were shit were evaluated really well, companies that were good were not evaluated highly, and I think we're seeing something pretty similar to today. And as you can see, the stock market did go up as much as it did, but it wasn't such sudden, it was slower, and these things take into account, it takes a lot of time for things like the internet, for example, to mature. And I think the same is going to be with AI. AI has gotten a lot better throughout the few years. For example, if you compare AI to now from 5 years back, it's a lot better now, but still it's not that fast. It's getting better slowly. Hardware's getting better, software's getting better, but I think the stock prices are getting way too ahead of themselves, and I think this is going to give a good opportunity for people that are patient and are really willing to wait a few years to actually see the results realize. So, for example, you could say that here in the peak of the bubble, we could think that we're now here, and now this is kind of inverted. People think that Adobe, for example, will fail and go bankrupt because AI will replace it. And AI might really replace Adobe. I wouldn't be too surprised of that. But I think the AI replacing of Adobe, people are realizing it now, but when it's actually happening might be in 20 years, in 15 years, in 10 years. And until then, these companies can still make good profit. They can have growth, they can make good profits, and that's where I come in. And that's why I've invested in Adobe. And I think this rotation of the stock market might be a good opportunity for you as well. I'm not going to go out here and recommend you buy some stocks or buy some companies, but you should look into them if you feel like there's something undervalued going on. I wouldn't say this for everything. There's companies that are going to go out of style faster, like for example Duolingo, because LLMs are so good with language that it's why would you need a Duolingo? You can definitely do anything you can with it with AI, and you can make those games with AI really fast. So I think that Duolingo, for example, will struggle a lot quicker than companies like Adobe. Then when we look at Constellation Software, they own a lot of smaller software companies. They are going to have some disruptions in there. Figma, for example, I wouldn't be actually too worried about Figma. Let's see a bit about them. Figma, as we're looking, it has a good products, this collaborative interface design, I think it's quite cool and good. Let's check the price. In 1 year, it's down a lot. Is there any financials? I think they're losing money, I assume. They're losing money. They made money in 2023. Yeah, I wouldn't buy Figma stock. Always buying companies where they don't have any earnings, where the earnings are negative. It's really hard to price that kind of company, and oftentimes I think those kind of companies are really overpriced, and they're a lot harder to evaluate, in my opinion. If you have a lot of insight and you have the knowledge and you have the time to evaluate these companies, of course, companies that have negative earnings, can be a good investment. But for me, it's just too hard to evaluate. I don't want to spend too much time on my investments. I just want to choose something and stick with it for a few years. Now let's watch the conclusion of the video and see what's hitting.
In a few months, the iShares Expanded Tech Software Sector ETF, which tracks the overall value of software companies on the stock market, has fallen by more than 30%. In other words, while the overall market has been booming, investors have been dumping software stock at record pace. Now,
luo kasvua Credin yritysten avulla. Paljonko
we're doing these ads.
Favorite. After all, blue chip companies like IBM and General Electric also went through a similar downturn when software companies first came onto the scene. But this time, it's different. Investors aren't asking whether these companies would make less money. They're asking if they'll exist in the next 5 years, if AI keeps developing at this pace. And from how the markets are looking, it seems like most of them have already answered that question. We're witnessing a complete repricing of the software industry, one not too different from a few decades ago, when the internet transformed the industry from selling physical products to services. Except this time, technology isn't working in software's favor, but against it. And unfortunately, the problem for SaaS companies doesn't stop with what AI agents can replace. It now extends to what they're making everyday people capable of. Take Monday.com, for example. This project management platform has seen its revenue grow nearly 400% since its IPO in 2021. Yet in the same period, its stock has lost more than half of its value. By every traditional metric, something is definitely wrong. And it's not like ChatGPT or Claude have features that can handle project management platforms. But for investors, that doesn't matter, because even though AI isn't scheduling appointments, it's letting regular people do things like this.
This morning, we said, let's see how hard it would be to create something like Monday.com. low-hanging fruit enterprise software. It's a task dashboard that's on top of the work that people do. Now, it also happens to be a $5 billion public company. Half an hour and a few prompts later, this is what I had: a functioning dashboard of tasks, owners, and status.
In just a few hours, workers at CNBC were able to create custom versions of Monday.com's software, the same software.
This is gonna happen. You know, these low-hanging fruit companies, these software companies that are not adding that much value, they might disappear really, really fast, because why would you pay for it? You know, for a big company, paying for it, it's not that bad, but at least for regular consumers, it's not that, why would you pay for it? And, you know, I think companies will realize this as well.
That the company locks behind a $14 monthly subscription. And while it's not as advanced or visually appealing as the actual thing, it's a functioning product nonetheless that was created by someone with no programming experience whatsoever. From this perspective, it's not hard to understand why investors aren't valuing these companies based on their actual performance anymore. Because what matters isn't whether these companies are profitable today, but whether they'll be around tomorrow. After all, for years, one of the main reasons investors had jumped at software stocks is their stable recurring revenues. But if businesses can simply build in-house replacements and load them with their own data, then that revenue stops coming in. But this investor pullback has created an even bigger problem for software companies. Last year, Salesforce laid off more than 4,000 employees, Workday 1,700, and Autodesk 1,300. These were just a few of the many software companies that laid off thousands of staff in 2025. And while many of them claimed improved efficiency with AI productivity tools was the reason behind these layoffs, the numbers tell a different story. You see, as these
This is really the sad part. Jobs are gone. You know, a lot of these software jobs, a lot of these coding jobs, they're just gone, and I don't think we'll ever really see them again, you know. So you have to see what the world goes into, but there's gonna have to be new industries where the demand for human, you know, work is required.
Increasingly difficult for them to raise the cash they desperately need to fund the development and to compete for talent. Remember, many of these companies, even after years of generating millions, still aren't profitable. They've always prioritized growth over profit, but now that investors aren't throwing piles of money at them anymore, they've had to cut costs, hence the layoffs. Meanwhile, AI companies are raising billions and casually paying out $500,000 checks to hire the best talent. In a last-ditch effort to keep investors on board, many of these same companies are now trying to pivot to AI. Go to the homepage of almost any major SaaS company, and it's nearly impossible to find a section AI isn't plastered front and center. Salesforce claims to be an AI-powered CRM.
That's what I hate. I hate companies, you know, talking about AI. You know, I think a lot of things in the recent years, they have not changed at all, but instead there's people talking about AI with them. You know, a few years ago there was like money seminars on how to get your money up. Now they're called how to get your money up with AI. And I think AI, of course, is a big part of our life nowadays, and it's just getting bigger. And you know, you should definitely learn it. There's a lot you can do, but still, you know, it's not the end all and be all of making great things.
Monday.com now insists it's an AI work platform, and Zoom says it has AI to make video calls better. But as it turns out, that may not be enough. During a recent earnings calls, even after beating revenue expectations, ServiceNow's CEO tried to reassure investors by saying ServiceNow is the gateway to this shift, serving as the semantic layer that makes AI ubiquitous in the enterprise. In other words, our workflow automation platform has nothing to do with AI. For 2 decades, is now very critical for integrating AI with businesses. The next day, the stock fell 12%, a clear sign investors weren't buying the AI pivot. Because here's the next uncomfortable truth many of these SaaS companies don't want to accept. Slapping AI powered on an existing product doesn't change the facts. If anything, it only delays the inevitable.
New jelly.
God damn, this guy's raking in the cash. 3 ads on a 14-minute video. That's crazy. I gotta get monetized. Yeah, that's about it for the video. What do you think? Do you think software companies are done? Do you think we're just, you know, seeing crazy irrational prices in the stock market? Or is it just this fear-mongering that's going around? Or what is really happening? In my opinion, software companies are not looking good. You know, AI is going to replace a lot of these companies, and oftentimes I think for many of these companies that's probably fine, that's probably good, but in the longer sense, you know, it's not here just yet, and a lot of these softwares still are more useful than the AI counterparts. LLMs can do everything. They can code pretty well nowadays, but you know, still I think companies like Adobe are gonna be pretty safe for at least a few years. Maybe, hopefully. That's it for the video. See you again. Bye.